Let's also welcome in Taher Badshah, who's joining us this morning. Taher, good to have you with us. We were just discussing the kind of recovery we're seeing on the pharma names, given that we've seen the index up about 4% year to date. We're also talking about, comments coming in from auto companies saying perhaps the worst is over. Are you also looking in or feeling optimistic that perhaps we're on the road to recovery now? Or, are you still being a little cautious?
Well, I think for the last a few months, I think almost about 5 to 6 months, we've been holding this view that the markets will probably see a gradual recovery. And more than the markets, I think we will probably see a better economic situation in the next 12 to 18 months compared to at least the last 18 odd or 24 odd months, largely predicated on a steadily improving global macro, decent liquidity situation in the global markets, and a gradual recovery even in the Indian context, both from a liquidity standpoint, especially in the banking system, and supported by broader market valuations being relatively reasonable. So I think we've been holding on to a relatively positive view for some time. We're not speculating on the extent of the recovery or the intensity of the recovery, but we feel that the markets are all about incremental. It's more about reality versus expectation, and I think if we were to probably even move from 5% or GDP growth to more like 5.5 or 6 in the course of the next few quarters, I think the markets will heave a sigh of relief and take it positively and build more optimism going forward. So I think we've been holding on to a relatively more constructive view in the last many months now, and that's the way we are positioned for ourselves into 2020.
It happens that some would say that markets are already pricing in, so where is the upside? I mean, right now, forget the real earnings surprise. We are right now focusing on contraction versus stability. So whenever the earnings come back, some would say that, look, markets knew recovery was coming, prices are, stock prices are pricing in, Nifty is at an all-time high. So for markets to go further higher from this level, what could be that trigger?
Well, I think it will be a combination of essentially the extent of the improving micro and overall liquidity situation in the market, and a return of NBFCs back to growth. So I think there is a fair bit of excess capacity in the system, and as we start seeing utilization of that, then it's difficult for markets to also immediately anticipate as to what can be the operating leverage that can play out. So we may probably have a earnings cycle which will probably run a little ahead of what market estimates are, and that may just provide the necessary fuel for the market to stay up. Besides, I think we've all been kind of brought up in this last 3-4 years of just looking at the Nifty valuations and then dismissing the market, and that never has really paid off in the last 3-4 years. Markets have done what they've had to do nonetheless, despite where the Nifty P multiple stands. So I think opportunities are there in the wider market, and I think that is what the market has already started to appreciate in the last 3-4 months, when we've seen the broader markets perform or outperform even the frontline Nifty or the BSE Sensex. So I think this proposition, to my mind, I think will get a little more wider in the course of 2020.
Taher, is it a concern what we've heard in terms of asset quality from an HDFC bank as well as Kotak? And do you fear at all that it could rub off on some of the other corporate-specific, heavily owned banks like an ICICI Bank or an Axis as well?
Yeah, so what we've seen as asset quality related pressures out of a couple of the banks which have announced their quarterly results are mainly stemming out of agri as one, and maybe MSME to some extent. I think agri probably, to my mind, will look a lot better in the case as we get into the later part of this year. We've seen food inflation actually being pretty positive. I think in the initial phases of this food inflation rise that we've seen over the last few weeks, I think we should probably be a little positive about that rather than being negative, simply because it will probably lead to better farm incomes and more spending power in the rural markets. So I think this problem which some of the banks have faced in the last few quarters, the agri stress should probably alleviate as we go along. They have expressed caution, and they have tried to kind of control their loan growth enthusiasm in the last in the last quarter. But I think that's just a matter of precaution. So I think some of the stress will probably fade away as we get into the as we get stronger results out of the rural markets. So that is something which is an additional factor which we look forward to in terms of the overall macro recovery. It will be a slow process. We will have bumps along the way. But I think we are kind of, we look at a confluence of factors, and it suggests that there is a reason to believe that some seeds of recovery are being sown as of now for the coming 4 to 6 quarters.
Okay.
What's the take then on what you do with Bharti? Because, the sector we all know is, at least seems to be headed in for a duopoly. But Bharti's got their FDI approval as well, and 100% quotient at that. The stock, of course, is just, points away from its all-time peak, already at a 52-week high. What next in store for the telecom sector per se?
Well, I mean, we've not yet heard the last word on whether it's going to be a 2-player or a 3-player market, and I think, but the key message, and we've been positioned in telecom across a couple of names in more than now 6 months. So, we've been essentially, our view has been predicated on potential recovery and the tariffs, and essentially with the aim that most of the players are subpar in terms of their return on capital in this business, and it is also not a business where capital intensity is going to fade away anytime soon. So restoring a healthy level of return on capital is beyond a particular point going to be paramount, and I think that call, we didn't really expect that it would play out because of the AGR issue, but it has started to play out, and I think we are at a stage where their ability to probably take more rate hikes, tariff hikes is still in place, given the essential nature of their telecom business, nature of their telecom activity as a utility. So I think we still have a long way to go in terms of the operating leverage that can play out, because that this is a very highly fixed cost oriented business, and a small delta in rates can make bring about a significantly large delta on earnings. So I think that story still remains, and to that extent, the journey could be pretty long and pretty exciting going forward, even from here on. But yes, I mean, we have seen a very sharp appreciation in stock prices in a very short period of time. So maybe they will probably kind of calm down, settle down here for a while. That's always possible. But I think the longer term, directionally, we still are pretty positive about the way the sector is shaping up.
Taher, what about FMCG? If you're also, talking about the recovery, does that also apply to, what we may see in FMCG? Reports suggest the worst is over, but neither are we really looking at some kind of dramatic improvement either. We have seen a lot of stress on the rural side, expectations from the budget, of course, and perhaps some amount of stability. What does that then imply in terms of, strategies with regards to some of those stocks?
So there are, FMCG, I mean, and the rural, case that we have, I think we are basically looking at, we are underweight staples as such, but that's primarily because of the high valuations which have been deterring us from being, overweight the sector. We have some stray positions in FMCG, but I think as a result of the return of consumer strength in the rural areas, as I mentioned earlier, I think FMCG should also benefit. Inflation, typically food inflation or overall inflation being reasonable, is always a positive scenario for FMCG companies. But obviously the challenge there is of valuation. So I think the other way to look at it is that the same rural benefit or rural growth returning, can it benefit other businesses either in consumer discretionary or some of the other areas which are rural intensive, and try and see whether there could be opportunities which address the bottom of the pyramid in other ways and other businesses. So I think we are trying to essentially skirt the valuation related issue which we have in FMCG, and are trying to see whether we can build positions and benefit from that same proposition through other businesses. So that's how we are looking at FMCG. So yes, I mean, to answer your question, we are currently underweight FMCG stocks across most of our strategies.
It's a big call then, because banks, some would argue back and say, look, they can't grow at this rate, right? I mean, 5 times book for Kotak, 4 times book for HDFC Bank, 15-20% incremental growth is here to stay. But will shareholders make money? I always ask this question to everyone, that great businesses may not be great stocks.
Yes, you're correct, and we need to differentiate between good businesses and good investments. But some of these banks who do trade at relatively more expensive valuations have not lost have not lost their ability to grow as and when the market becomes conducive for better growth, and they have done it in the past and the more recent past as well. So their longer term growth potential is not impaired. Is just a matter of caution and return of a better economic growth cycle, which we've probably not had in the last 18 odd months. So I think they still retain that option to always come back with better growth characteristics compared to what we've seen in the last 1 or 2 quarters. So they're the best equipped, in fact, even in the current circumstances, to come back to growth in terms of adequacy of capital, in terms of not having stretched themselves significantly as far as asset quality goes, and still riding on very strong liability franchises. So that still remains the key proposition out there. So yes, they are expensive in the short run, no denying that. But this expensiveness can be overcome very quickly with return to growth.
All right. Taher, thanks so much for joining us this morning and taking us through your views on how things stand currently.